Usually, when we look at a business's competitive advantage, their moat, we are looking for something pretty abstract.
Right, something digital, like a software ecosystem.
Exactly. You analyze a major tech firm, and their moat is essentially, well, it's just a stack of code, just sitting on a server farm in a cold room somewhere.
Yeah, the CEO points to a chart showing, user acquisition costs and daily active users.
Right. And that invisible digital architecture is literally the entire foundation of the company's valuation, which is clean and it's infinitely scalable, but it's entirely ephemeral.
Because the barrier to entry in that digital space is often just, a matter of who can acquire the most engineering talent or who can buy up compute power the fastest.
Exactly. It's a moat built on algorithms.
Yeah.
But then you step into the world of heavy industrial aerospace.
Oh, yeah. Totally different ballgame.
You step into the massive roaring mechanics of global aviation. Suddenly, that invisible digital moat is replaced by something you can physically touch.
Forged in titanium and carbon fiber.
Yes. We are looking at a competitive landscape forged in hard materials, ceramic matrix composites, real physical engineering. So welcome to the deep dive.
Glad to be here.
Today, we are putting on our Talk Tickers hats. Whether you are managing your own retail investments, prepping for a portfolio review, or you're just simply curious about how the actual gears of global commerce turn, we have a mission today.
And that mission is to decode the GE Aerospace Q2 2026 earnings conference call.
Exactly. We're translating that dense Wall Street jargon into clear, actionable insights for you. So we're going data forward. We'll break down the plain language of the mechanics. We'll take a definitive, opinionated position on what this means, and we'll leave you with a clear bottom line.
It's the four-part talk ticker structure: headline numbers, the story behind them, management guidance, and the bottom line.
Perfect. So let's just start with a number that sets the scale for everything we're going to discuss today. Just a massive figure.
Okay, lay it on me.
GE Aerospace currently sits on a commercial services backlog of $170 billion.
That is just, wow, $170 billion.
Right. And they have 80,000 engines currently in the air globally. And those engines represent 2.3 billion historical flight hours of data.
And, it's critical to understand that $170 billion figure, it is not a projection. It's not a total addressable market guess.
It's locked in.
Is contractually locked in future revenue. The mechanics of the aerospace industry literally dictate that if an airline is flying one of those 80,000 engines, they are legally obligated and physically obligated to bring them into a certified shop for maintenance.
For parts replacement, total overhauls, things like that.
Exactly. At very specific intervals. You can't just skip it like an oil change on an old Honda. And that 2.3 billion flight hours of data, that is perhaps the most impenetrable part of that moat.
Because it's real world data, not just theoretical models.
Right. GE is tracking telemetry on how a specific, high pressure turbine blade reacts to the ambient dust levels of a runway in Dubai versus the freezing moisture of a descent into London Heathrow.
Over millions and millions of flight cycles.
Yes. A competitor can't simply raise a bunch of venture capital, build a shiny new factory, and replicate the predictive maintenance models generated by 2.3 billion hours of real-world wear and tear.
They just don't have the time machine to get that data.
Exactly. That data dictates GE's supply chain, their pricing power, and their engineering cycles.
Okay, so that sets the table perfectly for the raw financials of this Q2 print, the headline numbers. And the numbers across the board indicate a business operating at a very, very high velocity.
The top line was staggering.
It really was. Total orders were up 17%. And revenue grew 24% year over year.
And didn't management note this was like a streak for them?
Yeah, they noted this is the 5th consecutive quarter of at least 20% revenue growth, which is, a rare trajectory for a legacy industrial manufacturer of this scale.
Usually you only see 20% growth streaks in software, not heavy machinery.
Yes, exactly. Breaking that revenue down, their commercial engines and services segment, which they call CES, drove the bulk of it with a 27% increase.
And the defense side.
Their defense and propulsion technologies segment, BPT, also grew by 16%.
Okay, solid growth across both major divisions.
Yep, and profitability followed that top-line growth. Earnings per share jumped 22% to $2.02. Operating profit hit $2.7 billion, which is an 18% increase.
But we have to talk about the cash flow, because that was the real standout metric.
Oh, absolutely. The metric that requires a real breakdown here is free cash flow. It surged 43% to $3 billion. And management highlighted a, quote, 140% free cash flow conversion rate.
Right, which sounds completely paradoxical.
Yeah, I mean, on its face, converting 140% of your profit into cash, it sounds like an accounting error. If I make $100 in profit, how on earth do I put $140 in the bank?
Right, it doesn't make intuitive sense. We have to look at the mechanics of corporate accounting to see how they actually achieve this.
Okay, break it down for us.
So net income, which is the profit figure you see on an income statement, is burdened by all these non-cash accounting conventions.
Like depreciation.
Exactly. The depreciation of their massive manufacturing facilities over decades. It also includes revenue they have officially recognized because they say delivered a jet engine, even if the airline has 30 to 60 days to actually pay the invoice.
Okay. So net income is essentially the theoretical profit based on accounting rules, whereas free cash flow is the actual hard liquidity generated during that specific 90-day window.
Exactly. Free cash flow is the capital they can actually use to pay a dividend, buy back stock, or build a new facility.
Which means the conversion rate is just simply the free cash flow divided by the net income.
Right. So a 100% conversion rate implies a perfect one-to-one translation of paper profit to liquid cash. To hit 140%, GE had to aggressively manipulate their working capital.
Wait, manipulate in a good way or a bad way?
In a highly efficient way. CFO Rahul Ghai specifically called out a nearly $200 million reduction in working capital this quarter.
How do you just squeeze $200 million out of working capital?
Through incredibly tight inventory control and receivables management. In physical terms, this means they stopped buying raw materials like, titanium stock or pre-preg carbon fiber until the exact moment it was needed on the factory floor.
So they aren't just letting expensive metals sit around gathering dust.
Exactly. They flushed out cash that would otherwise be sitting dormant on a warehouse shelf. And simultaneously, they accelerated the collection of cash from their customers for past deliveries.
So they paid their bills at the last possible second and got their customers to pay them as fast as possible.
You got it. They squeezed the operational timeline so tightly that they extracted 40 cents of latent cash out of the system for every dollar of recognized profit.
That is just a masterclass in liquidity management. But, let's look at the other side of that operational coin. Because there is a data point in this earnings report that seems to completely contradict that narrative of perfect efficiency.
You're talking about the margins?
Yeah. We have revenue up 24% and operating profit up 18%. Yet their overall operating margins actually decreased by 130 basis points, dropping down to 21.7%.
Right.
If a company is scaling its sales by nearly a quarter, you generally expect economies of scale to kick in and expand the profit margin, right?
Absolutely. In a traditional retail or software environment, 130 basis point margin compression during a massive growth phase would trigger a massive sell-off.
The market would assume the company's discounting heavily just to buy market share, or that their input costs are unmanageable.
Exactly. But aerospace is a different beast. You really need an understanding of the specific life cycle of jet engine economics here.
Okay, so why is a shrinking margin not a red flag here?
Because shrinking margins in this specific context are actually a leading indicator of massive future cash flows.
Wait, really? How does making less money per dollar of sales indicate more cash later?
Rahul Ghai attributed this margin drop directly to what he called installed engine growth. GE is currently in a cycle where they are shipping a huge volume of brand new engines.
Right, they are ramping up deliveries of the massive GE9X, which powers the new Boeing 777X.
Yeah, and they're pushing out thousands of LAP engines for the Airbus A320neo and the Boeing 737 MAX families.
And the economics of selling a brand new $50 million jet engine to an airframer like Boeing or Airbus are surprisingly brutal, aren't they?
Oh, extremely brutal. The initial sale of the engine itself is a very low margin transaction. Sometimes in the early years of a new engine program, particularly something as technologically ambitious as the GE9X, they often sell the physical engine at a significant loss.
A loss. They lose money selling a $50 million engine.
Yes, because they are amortizing billions of dollars in research and development, testing, and initial factory tooling across those early units.
Right. Management noted that the initial units of the GE9X are currently their highest cost units. They expect the negative margins on that specific manufacturing program to peak around 2028 before turning profitable.
Exactly. So let's frame this with an analogy that fits the scale of the business.
Okay, let's hear it.
Instead of the old consumer goods comparisons, think of a newly manufactured jet engine as a flying toll booth.
A flying toll booth. I like that.
GE is essentially paying Boeing and Airbus for the privilege of installing their toll booth on the wing of a commercial airliner. The initial installation costs them money.
Right, they take a hit up front.
But once that aircraft enters service, every time it takes off, every hour it spends cruising at 35,000 feet, the internal components are experiencing immense thermal and mechanical wear.
They're basically slowly degrading from the inside out.
Yes. And every unit of wear is a toll the airline will eventually have to pay to GE in the form of replacement parts, specialized labor, and full engine overhauls over the next 20 to 30 years.
So the initial margin hit is just the price of admission for a multi-decade annuity.
Exactly. When GE's overall margin drops by 130 basis points this quarter, it is a direct mathematical result of their success in securing market share today.
They are diluting their corporate margin right now because they are successfully bolting thousands of these new toll booths onto wings.
You got it. Every single one of those low-margin engine deliveries directly feeds that $170 billion backlog we discussed earlier.
Which is where the real money is made.
Furthermore, Guy noted that the services for the LEP engine, which has been in service for several years now, are just now starting to break even and turn profitable as those engines come in for their first major overhauls.
So GE is intentionally enduring a margin headwind in the 2020s to plant the seeds for an enormous high-margin structural tailwind in the 2030s and beyond.
Exactly. It's a classic razor and blades model, but on a massive industrial scale.
Which means the margin compression is a feature of their market dominance, not a bug in their manufacturing process.
Right. It's a sign of health, not sickness.
Okay, that brings us to the second part of our Talk Tickers breakdown. The operational reality driving these numbers. The story behind the data.
And this is where it gets really interesting.
Yeah, the data tells us the financials are strong, but the sustainability of this growth relies entirely on the mechanics of the aftermarket, right? And their ability to navigate a deeply constrained global supply chain.
Yes. The earnings transcript reveals two massive intersecting forces here.
That's right.
A structural boom in aftermarket service demand and an aggressive internal lean manufacturing initiative to clear production bottlenecks.
Let's start with the aftermarket boom. What's driving that? Because it seems like everyone is trying to get their planes fixed right now.
The aftermarket boom is being driven by a unique set of macroeconomic and industrial conditions. Coming out of the pandemic, global travel demand rebounded much faster and stronger than the industry anticipated. Passengers are flying in record numbers.
Revenge travel is still very much a thing.
Under normal circumstances, airlines would meet this demand by taking delivery of brand new, fuel-efficient aircraft. But the well-documented production struggles at both Boeing and Airbus have created a severe shortage of new airframes entering the global fleet.
The airlines have route networks they need to service today, right? If they can't get the new planes they ordered, their only operational choice is to extend the life of their older legacy aircraft.
Exactly. They're forced to fly planes they intended to retire.
And this dynamic is an absolute windfall for GE's legacy engine programs, especially the CFM56 engine, right?
Oh, the CFM56 is the undisputed workhorse of global aviation. It is a joint venture product between GE and the French aerospace company Safran, and it has powered thousands of Boeing 737 NGs and older Airbus A320s for decades.
CEO Larry Culp noted on the call that the rate of parked CFM56 aircraft, meaning planes sitting idle in the desert, has actually declined since the beginning of the pandemic.
Utilization of this legacy fleet is incredibly high. They're working these older engines hard.
And Culp dropped a specific statistic regarding the CFM56 that really highlights the sheer runway this program still has. He said that despite being an older generation engine, 30% of the active CFM56 fleet has not even seen its first major shop visit yet.
Which is wild for an engine program this mature.
And even more staggering, 2/3 of the fleet hasn't seen its second major shop visit.
Right. And to understand why that matters, we need to break down what a shop visit actually entails. Because this isn't like taking your car in for an oil change.
Yeah, paint a picture for us. What happens during a major engine shop visit?
It is a massive industrial undertaking. When an engine reaches a certain number of flight cycles, it is physically removed from the wing and shipped to a specialized facility. It is entirely disassembled down to its individual module.
Like the fan, the compressor, all that.
Exactly. The combustor, the turbine. The components are meticulously cleaned and subjected to intense non-destructive testing.
What kind of testing?
Things like fluorescent penetrant inspection or eddy current testing. specifically looking for microscopic stress fractures in the metal.
And certain parts inside that engine are what the industry calls life-limited parts, right?
Yes, LLPs. These are highly engineered components, like the rotating discs that hold the turbine blades, which are legally mandated by aviation authorities to be completely replaced after a specific number of flights, regardless of their visual condition.
So even if it looks perfectly fine, if it hits that flight cycle limit, it goes in the trash.
It has to. The safety margins are absolute. And as an engine ages and moves from its first shop visit to its second or third, the scope of work compounds.
It gets more expensive.
Much more. The deeper you go into the engine's life cycle, the more of those expensive, life-limited parts hit their mandatory replacement limits. The core components require much heavier, more intensive metallurgical repairs.
Therefore, the dollar value and the corresponding profit margin of each successive shop visit increases significantly.
Exactly. So when GE says that 2/3 of the CFM56 fleet hasn't hit that heavier second shop visit yet, they are signaling that the most lucrative phase of this engine's life cycle is still ahead of them.
Add to that the fact that internal shop visits for the newer L8 engines surged by over 50% year over year in the first half. And you have an aftermarket demand curve that is pointing sharply upward.
The demand is undeniable. It's a tidal wave.
But this is where we have to look critically at the supply side, because there is a tension in this transcript that management had to address. CFO Rahul Ghai noted that, quote, spare parts delinquency grew 20% sequentially in the second quarter.
Right, delinquency.
Delinquency means they are failing to deliver parts to their airline customers on time. A 20% sequential jump in late deliveries suggests a supply chain that is just straining under the weight of this demand.
It's struggling to keep up, for sure.
So, if this is supposed to be an elite manufacturing operation, how does an investor reconcile a massive jump in delinquency with a bullish outlook on the stock? Isn't that a huge red flag?
The delinquency metric is the ultimate governor on GE's growth right now. It is the ceiling they are bumping against. But, the context matters immensely here.
Okay, what's the context?
This delinquency is not born from a loss of market share or a design flaw that requires them to halt production. It is a symptom of overwhelmingly robust, almost insatiable demand outstripping the physical realities of metallurgy and machining.
They just physically can't make the parts fast enough.
Right. When your service orders are up 34% in the first half of the year, the physical capacity of the global aerospace supply chain struggles to respond.
You cannot just flip a switch and double the production of high-pressure turbine blades overnight.
You really can't. These blades are made from proprietary single crystal superalloys. The manufacturing process involves directional solidification, where the molten metal is cooled in a vacuum furnace in such a way that the entire blade is formed from a single continuous crystal lattice.
Wait, the entire blade is one single crystal of metal?
Yes. This eliminates grain boundaries in the metal, which are the weak points where microscopic cracks form under the extreme centrifugal force and heat of the jet engine.
That is insane engineering.
It is. And forging and machining these parts requires incredibly specialized tooling, rare materials, and highly trained labor. It is a fragile, inelastic supply chain, so the delinquency is a real bottleneck.
But GE has a plan for this, right? They talked a lot about something called flight deck.
Yes. GE's approach to clearing this bottleneck is the operational core of their current strategy.
They referenced flight deck constantly throughout the call. Now, this isn't a software platform, right?
No, it is a comprehensive management philosophy. It's derived from lean manufacturing principles, heavily inspired by the Toyota production system, but calibrated for the extreme complexity and regulatory rigor of aerospace manufacturing.
Got it. And the mandate of flight deck is to drive continuous improvements across 4 pillars in a very specific, non-negotiable order: safety, quality, delivery, and cost.
Exactly. You never sacrifice quality for delivery speed, and you never sacrifice delivery speed just to cut costs.
The implementation of flight deck is where Larry Culp's influence is most visible. He's renowned for his operational discipline, and he spent significant time on the call providing granular examples of how this philosophy is altering the physical layout of their factories.
The Lynn, Massachusetts example was perfect for this.
Yeah, let's talk about that. Culp detailed a specific intervention at their facility in Lynn, where they manufacture the F-110 engine. That engine powers military jets like the F-15 and F-16.
And demand for the F-110 is surging right now due to global geopolitical tensions.
Right, but the factory was struggling to meet output targets. Instead of just throwing more money at the problem by hiring more people or buying more machines, they applied flight deck.
They conducted a deep analysis of the physical flow of materials across the factory floor.
Because in legacy aerospace facilities, which have often expanded organically over several decades, a single part might travel miles back and forth between different specialized workstations before it is completed.
It's a classic lean manufacturing problem. Every time a part sits in a queue waiting to be moved or is transported across a massive facility, it represents wasted time and tied up working capital.
So what did they do?
By implementing flight tech, the team at Lin physically reorganized the factory floor. They moved from a functional layout where, all the milling machines are in one room and all the inspection stations are in another, to a cellular manufacturing layout.
Meaning they grouped the necessary equipment and personnel into tight sequential work cells dedicated to specific components.
Exactly. This drastically reduced the physical distance the parts had to travel and eliminated the queue times between isolated departments.
And the results of that physical reorganization were pretty dramatic. Culp stated that they reduced the overall production lead time for a critical F-110 component by roughly 60%.
60%, just by moving machines around.
By simply removing the friction from the physical journey of the metal, they were able to grow total F-110 engine deliveries by over 50% year over year. That is the power of lean manufacturing applied at scale.
And GE is not keeping flight deck confined to their internal operations. The aerospace supply chain is incredibly interdependent, and a bottleneck at a third-tier supplier can halt a final assembly line.
Right. If you don't have the bolts, you can't build the engine.
So Culp discussed how they are deploying GE engineers directly into the facilities of their key suppliers to run Kaizens.
What's a Kaizen?
A Kaizen is an intensive, short-term, continuous improvement event where a cross-functional team focuses entirely on solving a specific production choke point. He highlighted a Kaizen run with GKN Aerospace, one of their major suppliers of the massive structural fan cases that house the front of the engine.
Oh, I read about this. The inspection process for these fan cases was causing severe delays, right?
Yes. So GKN and GE engineers collaborated on the floor, implementing new visual work instructions and integrating new inspection technologies.
And through that dedicated Kaizen, they achieved a 90% improvement in inspection time.
Which is just phenomenal. A 90% reduction in the time it takes to verify the structural integrity of a major component is a massive unblocking of the pipeline.
Okay, so physical reorganization is obviously working, but that's only half the battle in modern supply chain management. The other half is information flow.
The data.
The call highlighted how GE is blending this traditional lean manufacturing approach with advanced technology, specifically using artificial intelligence to smooth out the chaotic communication of the global supply chain.
Yeah, they focused on their turbine airfoils team as a prime example of this. The concept here involves something called the bullwhip effect in supply chain logistics.
The bullwhip effect, walk us through that.
So if GE sends erratic, constantly fluctuating demand signals to a supplier, they say they need 100 parts this month, 20 the next, and 150 the month after the supplier panics.
They don't know what to expect.
Right. The supplier doesn't know how to staff their factory or how much raw material to buy. They either stockpile too much inventory, driving up their own costs, or they underinvest in capacity, which leads to parts shortages for GE when demand inevitably spikes.
To combat this, the airfoils team used flight deck principles to standardize exactly how they calculate and communicate their material needs. And then once the process was standardized, they layered AI predictive modeling on top to automate the demand signals.
Because the AI can analyze the massive trove of historical engine data, the current airline flight schedules, and the specific life cycle data of the engines currently in service to predict exactly when and where specific turbine airfoils will be needed.
It takes the guesswork out. The AI processes this data and generates stable, highly accurate demand signals. Management noted that by implementing the system, they cut the absolute number of demand signals sent to suppliers in half.
And they reduced the processing time required to generate those signals by nearly 90% across 190 different critical parts.
The outcome of that technological intervention is supplier confidence. When a supplier receives a clear, stable, automated forecast that they can actually trust, they're willing to invest in their own capacity and prioritize GE's orders.
Management noted that as a direct result of these clearer demand signals, the priority material input into GE from these suppliers increased by double digits sequentially.
So they are using AI to untangle the information spaghetti of the global supply chain, which directly addresses that 20% increase in delinquency we talked about earlier.
Exactly. The delinquency is the friction, and flight deck combined with AI is the lubricant they're aggressively applying to the system.
As they clear that backlog of late parts over the coming quarters, that delayed revenue will finally be realized, acting as a further catalyst for top-line growth. Which is a perfect segue into the third major area of focus from the transcript, management guidance.
Because the market is fundamentally a forward-looking mechanism. A strong Q2 only matters if it indicates a strong future trajectory.
Exactly. And the guidance delivered by CEO Larry Culp and CFO Rahul Ghai was a massive, across-the-board upward revision of their financial expectations for the remainder of 2026.
It was a very confident raise.
Let's lay out the specifics of this upgraded outlook. Previously, they had guided for full-year revenue to grow in the low double digits. They have now raised that expectation to high teens percentage growth.
A significant jump.
They also bumped their full-year earnings per share guidance up by 35 cents at the midpoint, establishing a new range of $7.65 to $7.85.
And crucially, they raised their free cash flow target by a staggering $650 million.
$650 million, establishing a new expected range of $8.9 to $9.2 billion for the year.
Contextualizing that cash flow number is important. Generating over $9 billion of free cash flow in 2026 puts GE roughly 2 years ahead of the most optimistic financial models they were presenting to Wall Street just 12 months ago.
They are generating cash much faster than anyone predicted. The velocity of their cash generation is accelerating incredibly fast.
What makes this upgrade particularly notable is the timing.
Yeah, talk about that.
Back in April, during their Q1 earnings call, GE delivered a very strong quarter. But Larry Culp, who is generally a conservative manager regarding guidance, deliberately chose not to raise the full-year outlook.
Right. He cited ongoing macroeconomic uncertainties, inflationary pressures, supply chain fragility, geopolitical tensions, all that.
But now, just 90 days later in July, despite those macroeconomic factors remaining largely unchanged, management is confidently raising their targets across every major metric.
So the question is, what gave them the confidence to push all their chips to the center of the table right now?
The confidence is derived from the unprecedented visibility they have into their own order book for the second half of the year. When pressed by an analyst on why they were raising guidance so aggressively in a volatile macro environment, Rahul Ghai provided a data point that essentially de-risks the immediate future for the stock.
What was the data point?
He stated that as they entered the third quarter, more than 95% of their expected spare parts revenue for that quarter was already locked in their backlog.
Wait, the third quarter had just begun, and they already had contractual commitments for 95% of the revenue they need to hit their targets.
Precisely. The oligopolistic nature of the aerospace industry, combined with the stringent regulatory requirements for engine maintenance, means this revenue is highly predictable.
It's basically a sure thing.
Furthermore, Guy noted that the pipeline of planned engine removals, which are the engines that airlines have scheduled to come off the wing and into the maintenance shops in the coming months, exceeds GE's internal full-year shop visit guidance by over 40%.
So they are fundamentally oversubscribed. They have 40% more planned maintenance work knocking on their door than they are currently projecting they can actually complete.
This fundamentally flips the risk profile. They do not have to worry about stimulating demand, finding new customers, or fighting for market share in the second half of 2026.
Their only operational mandate is to execute on the backlog they already possess.
Exactly. Even if global travel demand were to experience a sudden, unexpected softening in the fourth quarter, GE is shielded. They have months and months of pent-up, oversubscribed, high-margin maintenance work to chew through before a macroeconomic slowdown would ever show up in their financial statements.
Okay, I hear the bull case, loud and clear. But a critical analysis requires us to look for the structural risks, even in a bullish report.
We always have to look for the cracks.
While the $170 billion commercial backlog is a massive moat, it is completely reliant on maintaining strong relationships with the airlines. And there is a well-documented tension in the industry right now regarding the newer generation of engines, specifically the L8 engine.
Oh, yes. the LA engine durability issues.
During the Q&A portion of the call, an analyst directly challenged Larry Culp on this issue. Airlines have been highly vocal in the aviation press about their frustrations with the cost of ownership associated with the new L8 engines.
The airlines acknowledge that the fuel efficiency is incredible. They save millions on jet fuel, but they are complaining that the maintenance burdens and the durability of the engines are worse than they expected.
Right. And if the airlines are unhappy with the product, does that begin to erode GE's pricing power and threaten the long-term viability of that aftermarket mode?
It is arguably the most significant operational challenge GE faces with their current product line. To understand the airline's frustration, we have to look at how an airline evaluates an engine's performance. Fuel efficiency is critical, but the ultimate metric is time on wing.
Time on wing.
Yes, time on wing is exactly what it sounds like. The number of flight cycles an engine can complete while bolted to the aircraft, generating revenue before it has to be removed for a heavy maintenance overhaul.
Because every day an engine is sitting in a repair shop, the multi-million-dollar aircraft it belongs to is grounded, earning zero revenue for the airline.
Exactly. And the LEAP engine's time on wing has been falling short of the airline's expectations, largely because of the physics required to achieve that incredible fuel efficiency.
How so?
To get more thrust out of less fuel, the LEAP engine operates at significantly higher internal pressures and temperatures than the older CFM56. The environment inside the combustor and the high-pressure turbine is extraordinarily hostile.
How hostile?
Operating at temperatures that actually exceed the melting point of the metals used to build the engine.
Wait, the engine operates hotter than the melting point of its own parts. How does it not just turn into liquid?
They manage this by using complex internal cooling passages within the turbine blades, blowing cooler air through them, and applying advanced thermal barrier coatings.
Oh, I see.
But the sheer thermal and mechanical stress accelerates the degradation of these high-pressure turbine components. The metals fatigue faster, the coatings wear down, and the engines have to be pulled off the wing for maintenance much sooner than the airlines were accustomed to, with the legendary bulletproof reliability of the older CFM56.
So the airlines are essentially arguing that the fuel savings are just being consumed by the increased frequency of expensive engine overhauls.
Exactly. It's eating into their operational margins.
Now, GE is keenly aware that they cannot simply ignore these cost of ownership complaints. If they alienate their customers in a duopoly market, they open the door for competitors to exploit that dissatisfaction.
And their response, detailed extensively on this call, is a massive engineering intervention.
What are they doing?
Management announced a critical milestone. They have officially completed the certification for the LEAP-1B durability kit.
What exactly is a durability kit? It sounds like an aftermarket bumper for a truck.
It's far more involved than that. This durability kit is not a minor software update or a simple tweak to a maintenance schedule. It is a fundamental hardware upgrade centered around a redesigned high-pressure turbine blade.
So new parts entirely.
Yes. GE's engineering teams have utilized advanced materials and redesigned the internal cooling architecture of the blades to withstand the extreme thermal environment of the LA engine for significantly longer periods.
And Larry Culp stated that the installation of this durability kit is expected to deliver approximately a twofold improvement in time on wing.
That's the headline right there, a twofold improvement.
They are engineering a solution that will effectively double the amount of time the engine can stay in service before requiring an overhaul. That level of improvement bridges the gap, bringing the LA engine's durability much closer to the historical expectations set by the CFM56, while still maintaining those massive fuel efficiency gains.
And the rollout of this hardware is aggressive. Culp noted that they already have a similar durability kit installed on over 40% of the LA-1A fleet, which is the variant that powers the Airbus aircraft.
And with the new certification, they are now authorized to begin retrofitting the LA-P-1B fleet, which powers the Boeing 737MX.
By heavily investing in R&D to solve the fundamental physics problem driving the customer complaints, GE is protecting their long-term franchise. They are prioritizing customer loyalty and aircraft availability over short-term cost savings.
Right. Culp emphasized this commitment by noting that they have driven the number of grounded IDI-powered aircraft due to engine availability down to, quote, nearly zero.
They are ensuring their customers can keep their planes in the air, which cements the relationship and secures the integrity of the $170 billion backlog.
They are absorbing the short-term engineering and manufacturing costs to fortify the long-term structural advantage of the business.
Exactly. It's a smart long-term play.
Okay, we have broken down the raw data, we have explored the supply chain mechanics of flight deck, and we have analyzed the confidence behind their upgraded guidance. It is time for the final piece of the talk ticker structure. We need to deliver the bottom line for the listener.
Let's do it.
Based on everything we've covered, I think the synthesis of this earnings transcript provides a definitively bullish signal for GE Aerospace.
I would absolutely agree. Bullish all the way.
The slight operating working compression we saw in the second quarter should not be interpreted as operational bloat or pricing weakness.
Yeah.
It is a strategic, calculated expansion of their installed base.
Yes. By delivering record numbers of new lower-margin LA and GE9X engines today, GE is aggressively seeding the global fleet. They are contractually locking in highly lucrative, high-margin aftermarket service revenue that will literally span the next 3 decades.
The foundation of this business rests on massive structural tailwinds that are largely immune to short-term macroeconomic fluctuations. You have a massive legacy fleet of CFM56 engines that are just now entering their heaviest, most profitable overhaul cycles.
You have a rapidly expanding fleet of LAPE engines that are beginning their own 20 to 30-year service life cycles.
And you have an operational culture driven by flight deck and AI integration that is systematically dismantling the supply chain bottlenecks that are constraining their immediate growth.
For an investor, whether you hold the stock or are considering it, GE Aerospace represents a highly visible, compounding earnings machine protected by a $2.3 billion flight-hour moat.
It's hard to argue with those numbers.
No.
But as always, true long-term analysis requires us to look over the horizon. The current thesis we've laid out is entirely reliant on the complex mechanical wear and tear of the combustion jet engine.
Which brings up a very interesting point for the future.
It brings us to a final, provocative thought to consider as we look beyond the 2026 numbers and toward the 2030s. We just spent a significant amount of time explaining how GE generates its massive cash flows. They do not make their real money selling the engine, they make their billions fixing the engine.
Right. The extreme heat, the immense friction, the thousands of moving, degrading parts, that physical destruction is the very source of their $170 billion aftermarket moat.
But buried in the middle of this earnings call, management briefly teased their upcoming presentation at the Farnborough Air Show. They discussed their ongoing development of a NASA megawatt-class hybrid electric demonstrator aircraft.
They also mentioned their partnerships with disruptive aerospace firms like Beta Technologies to develop advanced electrical power systems and turbogenerators.
So they are actively researching and funding the electrification of commercial flight.
They have to stay ahead of the curve.
But the physics of electric propulsion are fundamentally different from combustion. If the long-term future of aviation inevitably shifts toward hybrid systems or eventually fully electric propulsion, the mechanics change completely.
Electric motors have a fraction of the moving parts of a traditional turbofan jet engine.
Exactly. There is no combustor operating at 3,000 degrees. There are no highly complex, single-crystal, high-pressure turbine blades slowly melting over thousands of flight cycles. There's simply far less friction, less heat, and far fewer complex components that require constant, expensive replacement.
It raises a fascinating paradox for the long-term structure of the aerospace industry.
As GE aggressively innovates to invent the clean, efficient future of flight, will this inevitable technological leap toward electrification eventually disrupt their own highly lucrative maintenance model?
If you successfully engineer a simpler, nearly frictionless electric engine, do you inadvertently destroy the massive aftermarket moat that currently defines your valuation?
It is a question of whether innovation will eventually break the very mechanics of their profitability, and it is something for you to mull over as the industry slowly transitions toward the next era of flight. That is all for today's deep dive. We will catch you on the next one as we keep translating the ticker tape into truth.